Topic 5, partnerships. In this topic, we will be covering the net income of a partnership, the taxing of the partnership income in the hands of each partner, and then looking specifically at how we treat things like interest on capital, interest paid on drawings, partners' salaries, superannuation, and such things as capital gains and dividends in a partnership. When we finish the taxing of partnerships, because this topic isn't a large topic, we'll go on and look at reconciliation from accounting profit to taxable income or net income. Reconciliations will affect us for the rest of the course, whether we're looking at partnerships, trusts or individuals. It's also the issue that causes probably the greatest concern with students. So you will need to spend a bit of time on reconciliations. Partnerships. The first thing we're going to do is look at what is a partnership. And the definition of a partnership is in section 995-1. And if you note, it's a wider definition than the common law definition of a partnership. So not only is it people carrying on business together, but for tax purposes, it's people who are in receipt of income jointly. So that could be two people who own a rental property. Because they're receiving income jointly, they actually fall within the tax definition of a partnership. A few points about partnerships. A lot of people like to use partnerships because it's a very simple structure. So you often find a situation where it's a husband and wife who operate a business in partnership. But partnerships are fraught with difficulties from a tax point of view, particularly where you have one partner who's actually been running a business and then they're advised that for tax purposes it's a much better idea to form a partnership, and so they simply set up a partnership and really nothing changes. The original partner who was actually carrying on the business continues to carry on the business, and the only difference is that now the income is split between the two partners. If you want to get an idea of the benefit of running a business via a partnership instead of as a sole trader, just think about the tax payable on $180,000. Look at that figure and then look at running that same business in a partnership and splitting the income equally between two partners, so each partner now earns $90,000, and work out how much tax as a family they would pay on that same $180,000, and you'll see it's a considerable saving, which can amount to a few $100s a week. From memory, it's about $14,000 a year. So the saving is like over $200 a week. So you can see the benefit in having a partnership instead of running the business as a sole trader. The issue is there actually a partnership? And the Commissioner looks at what is really happening as opposed to what's there on paper. So while you don't need a partnership deed, it's probably a good idea to have one. It's one more thing that you can use in support of the claim that you have a partnership. However, the Commissioner can still put that aside and say the reality is there is no partnership. It is just this one person doing the work, doing everything, and so we don't have a partnership. For our purposes, we will be treating, if I say it's a partnership, you will know that we are treating it as a proper partnership. The main problem with a partnership is that we have these husband and wife partnerships, and if you want to run a business in that way, it's very important that everything is set out to show that it is a partnership. So it's a good idea to change invoices, letterheads, bank accounts, all that sort of thing, and notify people that you deal with that if the business was run by one person, it's now being run in partnership. And it's a much better idea to have letterheads showing, the business of whatever is, A and B Smith trading as, Smith Enterprises or whatever it is, so that people can see that it really is a partnership. So we now come to, having decided that we have a partnership, we now come to the taxing of a partnership. And the first thing you need to do is look at the definition of net income in section 90. Now, section 90 is important because it says this is the definition of net income. Now, until now, we've looked at taxable income for an individual, and the individual then pays tax on that income. Now we look at the net income of a partnership, and it's called net income, not taxable income, because that net income is then distributed out to each partner, and he, she or it will then include that partnership income with other income to arrive at their taxable income. So we talk about the net income of a partnership because a partnership doesn't pay tax, but it lodges a tax return. This is in section 91, and you'll see in section 92 that the income is distributed out to each partner, who then pays tax on their share as part of their normal income. So the first thing is the net income of the partnership. And the net income is defined as being the assessable income of the partnership, calculated as if the partnership were a taxpayer who was resident. What that means is it includes income from all sources, Australian income, overseas income, and it means that all the rules we've looked at before, derivation of income, deduction of expenses, all continue to apply. So as if the taxpayer was a resident, were a taxpayer who was a resident, so that's fine. It's everything we've done in topics 1 and 2. Less all allowable deductions, but then it goes on to say, however, it excludes personal superannuation for each of the partners and carry forward losses. So it excludes personal superannuation and carry forward losses. Now, you'll see why in a minute. So if we look at this example, and this is a very, very simple example, where we have a partnership with income of 10,000, deductions of 4, a loss, the partnership made a loss the previous year of 1 and paid $3,000 in superannuation for the partners. Now, if we look at that definition, it says all income, less all deductions, except personal super for the partners and carry forward losses. So therefore, all we can do is take into account the 10,000 minus the 4,000. And that gives us a net income of 6,000. So that's the first thing to remember, that the partnership cannot deduct the superannuation, and you'll see why the partnership doesn't deduct the carry forward loss. Having said that, that's basically the taxing of partnership income. We exclude personal superannuation and we exclude the carry forward loss. And that income or the loss goes into the hands of each individual partner. This is in section 92. It says the income of a partner will include his or her share of the net income of the partnership. So in that partnership where they made, I think, $4,000 net income, each partner gets $2,000. They include that $2,000 with any other income and pay tax on it. If it was a loss, they would get the loss and offset that loss against any other income. And that's actually one of the benefits of a partnership. If you know you're starting a business at and it's going to run at a loss and you've got other income, often people will start as a partnership, use the losses against their other income, then as the business becomes successful, they might roll it over into a company and then issue dividends and that sort of thing. Now, the complicating factor, and really if it wasn't for the coming issues we're going to discuss, we would have just ended our discussion there. Let's go back now and think about what is a partnership. Now, you would have done this in your earlier studies when you did your basic sort of law unit. So let's look now at the fact that a partnership is made up of the 2 or 3 or however many partners. So a partnership is something you can actually find, as opposed to later when we look at a trust or a company. With a partnership, you can actually say, look, here's one of the partners, here's the other partner, these sort of living, breathing people. Now, when you think about that and you think about how a partnership is started, let's say you've got 2 unrelated people who want to start a business in partnership. Now, what might happen is one partner is actually going to keep working in another for an employer, but they're both going to put money into the business so that the business can operate. Now, that is called the capital. So one partner may well put in 50,000 and the other partner puts in 100,000. One partner is going to work in the business and the other partner maybe will just come and work on the weekend. The other thing that happens is, if you think about it, the partnership is operating all through the year. There's this business operating. The partner who's working in the business 5 days a week and has no other source of income obviously needs some money to live on. So the usual arrangement would be that the partner who's going to work 5 days a week will receive a salary. It's called a partner's salary because it's a regular payment that's made. Now, the other partner, who might only come in and work on the Saturday, might get a much smaller salary. So let's think about the partner working full-time in the business getting $1,000, the other partner getting $200 a week. So that's the partner's salary. Now, the other thing that partners do in a business is, while they might be drawing their while they might be taking their $1,000 salary, their $200 salary, what might happen is, if the business is doing well and there's a reasonable amount of money in the bank, they might think, well, let's take some of our share of the profit before the end of the year, because obviously you don't want to have to wait a whole 12 months to take out anything more than your $1,000 salary or your $200 salary, especially if there's considerable money sitting in the bank. So what partners do is they draw money out of the business, and this is called a drawing. And it's really just taking their share of the profit before they know what the profit is. Now, and those amounts are called drawings. Now, at the end of the year, when you work out the profit for the business, and we're going to see in a minute how we deal with those partners' salaries, but at the end of the day, you'll work out this partner's share is X thousand, let's say for argument's sake 100,000, and they've drawn out, so the extra amount they've taken was 80,000. Now, they're going to pay tax on the 100. They've already taken 80,000, so they can take another 20. Now, students get really confused with this issue of drawings. And one of the ways I explain it is, let's say when you were younger, you were getting $10 a week pocket money. So at the end of the year, you were going to get $520 from your parents. What might have happened was, you might say to your parents, look, I really want to buy something and it's going to cost me $200. Can I have my pocket money in advance? And your parents give you that $200 in advance. Then you can take nothing more until you've used up your $200, and then you start getting your $10 again. Now, that's like your drawings. The partners say, well, we know we're going to get profit at the end of the year. The only thing is, you don't know how much. So what we're going to do, we know that there's money in the bank. We're going to take in advance 80,000. Then when we know what the correct profit is and our share of that profit, we'll take out any more. Now sometimes, of course, partners don't take all the money out. They will leave money in the business because the business might need more capital, not more capital, but it needs money there. So they're not, say, borrowing money from the bank to fund their day-to-day operations. But at the end of the day, what happens is you work out the net income of the partnership and distribute out the shares to each, their share of the profit to each of them. And then that amount of money is what each partner will pay tax on. Now that has nothing to do with how much money they've drawn out of the partnership. So you can have an instance where a partner might draw out more than their share. And what you've got sitting in the background is a partner's loan account. Now that's completely separate to the tax position. So for example, let's say one of the partners was renovating their home and they'd borrowed money from the bank in their own name and all the rest of it, and they were running a bit short of money, and the bank, they didn't want to go back to the bank. And let's say there was $200,000 sitting in the partnership bank account. Obviously the partners would discuss it, and that partner might well take the full $200. Now, when the net income is worked out, their share is $100,000 each. Each of them would pay tax on $100,000. But in the partnership loan account, one partner is in deficit because that partner's drawn out $200, but was only entitled to take $100. So they're now in deficit. And what that means is next year, let's say there's another $100,000 profit, that goes into the loan account and brings that loan to nil. And obviously that partner can't draw any more money out of the business. Or if they do, then their deficit will just get bigger. So I hope you understand the difference between what they're taxed on and this issue of drawings. So if you think back, it's really, drawings are just taking something in advance and then sort of at the end of the year they're allowed to take a bit more money if they need to. But that is completely separate to the amount of money on which they pay tax. Now, let's get back to our salary. At the start, we had this partnership and it was a 50-50 partnership. But we know that one partner was being paid a salary of $1,000 a week, which came to $52,000. So we can't simply say at the end of the year, well, here's our income, here are our expenses, and we've got whatever the profit is, and we're going to split it 50-50. Because we know from the very beginning that one partner has already taken $52,000 and the other partner's taken $10,400. So partners' salaries are considered to be an early taking of some of the net income. So it's not tax deductible to the partnership because effectively they are paying themselves. And the example that I give my students in class is, it's like me at the end of this lecture. I can't go back to my office and out of my wallet I take $10 and I say, Colleen, that was a great lecture. Here's $10. I'm not actually $10 better off. The only difference is I have $10 less in my wallet and $10 more in my hand, but my net position is exactly the same. And that's the case with the partnership. They are paying themselves. They have this body of money at the end of the year. So they take their income, they take all their operating expenses off, and what they've got left is this profit figure. And it belongs to the two of them. And what we have to say now is, how do we distribute that? We can't just split it equally because we know that one person has already got $52,000 and the other person's got $10,400. So the first thing we do is when we get the net income figure, we say, well, what salary did each partner take out of the business? Because we know that that's money they've actually taken. And it was a fixed amount that they took each week. So the first thing we do is we say, okay, partner 1 got 52,000, partner 2 got 10,400. What does that add up to? Now have a look at my answers and you'll see that in each of these questions I've got partner 1, partner 2 and total. If you follow my setting out on these, you cannot go wrong. And yet every year as I mark the papers, students decide to go off and do their own thing. Don't do your own thing. I've done all the hard work. Follow the setting out and you cannot go wrong. Each time students go wrong is because they decide to go off and do something else. So the first thing, remember, we're sitting there with this pot of money and we're saying, well, you know, you've already got this much and you've already got that much. Okay, we'll put that in. The next thing is interest on capital. Remember we said that one partner put in 50 and the other partner put in 100, which they used as the capital of the business. Now when partners put in unequal amounts, obviously they want to be recompensed for the fact that one has put in more money than the other. So often what a partnership will do is they'll pay themselves interest on their capital. So they might say, okay, we'll pay ourselves 10% on the capital that we've put in. So one partner is paid interest of 5,000 and one is paid interest of 10,000. Now again, we know that they never really get it paid in cash. It's always done by way of journal entry because what they're trying to do is they're trying to sort of equalise their positions. And the partner who put in more is saying, well, you know, I could have left it in the bank and got interest on it. So they pay that so everybody's sort of on a level footing. So we know then that one partner's now got 5,000 and the other partner's got 10. So that's 15 in our total. The other thing that happens is where partners have drawn. Remember, drawings are taking your share of the profits before you know what profits are. One partner, remember our partner who's doing the home renovation and has taken the full 200,000 that was sitting in the bank. Now, the other partner says, well, you know, I'm happy for you to have that, but we could have been earning money on that. If that was sitting in the bank in the partnership name, our partnership would have been earning money on it. Or if you'd had to go and borrow that 200,000, you would have to pay you would have to pay interest. So I think you should pay the partnership interest. So let's say that partner has to pay the partnership 10%. If it's on the 200,000, that's $20,000. But where does the 20,000 come from? His partnership money. So the way they do it, they just show it as a minus. So instead of him getting, like, we're still going to distribute what's left, but it just comes out of his or her share of the partnership income. So that shows as a minus. So we've got money you've taken, you've been given a salary, that's a plus. Interest on your capital is a plus, and then this is a minus because it's what you should be paying back to the partnership. We do those first. The total is really important because what we now know is of that net income, we've paid this much in salary, so that's allocated out. We've paid interest on capital. We've got back interest on drawings. And so you do that calculation as you go. Now, what's left of the net income is then distributed 50-50 to each partner. So follow that setting out. Salary paid by the partnership, interest on capital, less interest paid on drawings, and then you'll see if you take the net income take off that total. The difference is what we then split among each partner. And if it was a 30-70 partnership, at that point we would split it 30-70. Okay? So that is how we distribute the net income of the partnership. We have an example now, and if you look at it on the slide, you'll see there are sales, interest on capital, partners' salaries, then the interest paid, and we've got an accounting profit. What we now need to do is say, well, that might be the accounting profit, but is it the net income of the partnership? And now we apply the rules that we've looked at. So for sales, obviously that's income, but we now know that the interest on drawings is not income of the partnership. Please remember to give a reason for excluding items. And so at this point you would say not partnership income. So we have assessable income of $150,000. Then our operating expenses are $100,000. And when we come to the partner's salaries and the interest on capital, they are not partnership expenses. Now, what's amusing is I've just finished marking some exam papers, and some of the students get a bit carried away. And even when we come down to partner's salary and interest on capital, the reason given is still not partnership income. What a terrible way to lose 2 marks. So income at the top, expenses at the bottom. So the net income is $50,000 as opposed to the accounting profit, which is $40,500. Now, we distribute that income. How do we distribute the $50,000? So remember, what do we know they've already taken in cash? And we know that they've taken the salary, $5,000, $10,000. See my total on the side? We know that they've given themselves interest on capital, which isn't a tax deduction for the partnership. It is part of their income, $250 to give you $500, $15,500. Then we take off the interest on drawings that they paid back. So that happened to be the same, $3,000 to give you $6,000. So you take the $6,000 from the $15,500 and you get $9,500. Now, if you then take the $9,500, which we know has either been paid or received back, from the $50,000 net income, the difference is $40,500. And that figure we split. Now, in this case, because it wasn't an equal partnership, one partner got $16,200 and one got $24,300. That gives them a partnership distribution of $18,450 and $31,550. Now, attend to that first. And then if you know that one of the partners has got more income from other sources or other expenses or whatever, you deduct all those after this point. And the reason this setting out is so important with the total column, because the total column tells you how much you've got left to distribute, that $40,500, which you wouldn't know if you hadn't done the totals. It's important to understand that this is only relating to the net income of the partnership. And that's why it's so important to get your thinking straight. So we're saying the partnership had this income, these expenses, this is the net income, and now we're going to distribute it as we've done. In a paper I've just finished marking, the question went on to say that one partner had a salary from another job and also had dividends with franking credits. Now, some students, because they saw the word salary, they immediately, having done the net income correctly, that salary from the outside employer, they put into that top line. And that just shows they actually have no idea what they're doing. So simply seeing the word salary, they thought, oh, it goes up there. It doesn't go up there because it wasn't partnership income. It was income earned outside the partnership. So please think straight as you work through this. Now, in this question, if I'd said that one partner had taken drawings or advances of $15,000, it makes no difference to our calculations here. Even if, say, partner one had taken drawings of $20,000, we wouldn't assess partner one on $20,000. His or her loan account might be in deficit, but it has nothing to do with the tax position. So here we're talking only the tax position. We're not talking about the cash position. So partner one may have taken lots more money as a drawing because there might be more money sitting there in cash. It has nothing to do with the net income and the partnership distribution. Please really come to grips with that because it's the one area that causes so many problems for students. What I should have said before was the issue of arm's length loans. Remember we talked about the partners lending money into the partnership as operating capital. What might happen as time goes on, the partnership might need some more money, some funds, and there's the option, of course, of going to the bank and borrowing the money from the bank and paying interest to the bank. One partner might well say, well, look, why are we borrowing $100,000 from the bank? I've got $100,000. How about I lend that to the partnership instead as a proper arm's length loan? So they'd find out what would be the interest rate and that sort of thing. And the partnership actually pays interest on that loan. But that is a separate sort of standalone loan as opposed to putting capital into the business. And interest on that loan would be deductible to the partnership, and that interest after calculating the partnership distribution would be interest of that particular partner. Now we come to the issue of partnerships and capital gains. If you have a look at section 106-5, it says that capital gains are dealt with in the hands of each partner, not in the partnership. So if there's a capital gain, they've sold part of the business, or they've sold land or buildings of the business, or they've received a lease premium, all that is dealt with in the hands of each individual partner. It has nothing to do with the net income of the partnership. So if we look at our example again, except now the partnership sold an asset and made a capital gain of $30,000, it's assessed in accordance with each partner's share of the partnership. So now we do everything we did before: salary, interest on capital, less interest on drawings, split the remaining income, and then that capital gain is split in accordance with the partner's interest in the partnership. And so one gets $12,000 and one gets $18,000. You'll know at this stage, you'll notice, I should say, I've stopped worrying about the total because the total was only important to get to that net income. Now we know that we've got a $30,000 capital gain and we just split it in their percentages. Superannuation. Remember we said, because of our definition in section 90, that superannuation was not a deduction of the partnership. Instead, it is an expense that each partner will claim in his or her share, his or her tax return. So, and again, students get really concerned. They want to sort of take this into account in our little distribution of partnership income. This is usually handled again via the loan account. So if we now assume that we had the superannuation of $4,000 for each partner, everything we've done to date doesn't change. However, what it will do is it becomes a deduction to each partner individually. So the $4,000 is now a deduction and the taxable income drops accordingly. The other thing we need to look at is the issue of franked dividends in a partnership. If the partnership receives a franked dividend, the cash amount plus the franking credits are income of the partnership, and then accordingly, of course, each partner gets his or her share of those franking credits. So let's go back into our example, and if we say that now let's reduce our sales by 10,000, and that 10,000 is now made up of 7,000 cash dividend and $3,000 franking credits. So now our net income doesn't change, just how we make up the 50,000 doesn't change, just how it's put together changes. So now our sales are 140, we've got dividends of 7, franking credits of 3, so we've still got assessable income of 150. We take off our expenses. Note again how I keep giving my reasons for excluding items. My net income is still 50. We go through the same thing that we did before, the salary, interest on capital, less interest on drawings, split the remaining income, so none of that is different to what we've done. The only difference is that when we come to calculate the tax, we take off, now here we also take into account our low income rebate, and we take off our franking credits. So because they were $3,000, partner 1 gets $1,200, that's their share, and partner 2 gets $1,800. So there's no need to show it separately in the distribution of the partnership income. You just need to remember that the partner gets to take it off in calculating his or her share of his or her taxable income. So that takes us to the end of partnerships. And really, there's not that much in it. The main thing is to calculate the income of the partnership as if the partnership was a normal taxpayer. We have income, less expenses. We don't have carry forward losses, and we don't have personal superannuation. And that makes sense because, of course, if the partnership made a loss last year, the share of the loss went out to each partner who used it to reduce their other income of that earlier year. So that's why we don't take into account carry forward losses. Then the main issues are things like how do we treat salary, interest on capital, both of which are not deductions to the partnership, but will be taken into account in distributing the net income. And similarly, interest on drawings is not income of the partnership, but we take it into account in calculating the distribution of the net income. And what we're saying is the partnership made a net income of X. Now, how do we distribute it? What do we know people took? So we give them those amounts, that's the salary. We give them the interest on capital. Oh, they had to pay some back. So we reduce their share, and whatever's left we distribute in their partnership percentages. With capital gains, remember they are ignored in the partnership, but we take them into account at the level of each partner. And then we have the dividends are included in partnership income. The thing you need to remember is to allow the franking credits when we take the tax into account, when we're calculating tax. So now we come to reconciliations. And this is probably the most difficult part of the course for students. And the reason it's difficult is because students never really understood topics 1 and 2, and to a lesser extent topic 3. If you understand everything we did in those topics, the reconciliation is actually very, very easy. Because what we're saying is that what might be income for accounting purposes is not income or may not be income for tax purposes. What may be deductible for accounting may not be deductible for tax. Or something which is not accounting income is income for tax. And similarly, you might have a deduction for tax purposes that is not a deduction for accounting purposes. So what the reconciliation is doing is it's saying, if this was accounting income, and I always say, look, pretend you're starting at zero. If it was accounting income and it increased your income by $10,000, but it's not $10,000 worth of income for tax purposes, you have to reverse the effect it had on your accounting profit. So if it increased your income, to get rid of it, you decrease your income by that amount. And then if a smaller amount should be income, you increase your income for tax purposes by that amount. Now, the classic example here would be a capital gain. If you bought an asset for $100,000 and you sold it for $200,000 so that you made $100,000 profit, your accounting profit is $100,000. So your accounting profit went up by $100,000. However, because you held that asset for more than 12 months, the capital gain is only 50%, which is $50,000. So let's go back. For the effect on accounting was to increase your profit by $100,000, but we know that it shouldn't be 100. So we remove that 100,000 accounting profit. So that's our deduction. We're lessing. So reconciliation is a lessing because it increased the profit. Now we're going to decrease it. And what should it have been? We're going to increase it by 50,000 because that's the correct tax treatment. If, of course, it was an active asset in a business, then we would have increased our accounting profit by 100, we decrease our accounting profit by 100, and we only increase our income for tax by 25,000. So can you see that you would have this discrepancy between what's income for tax and what's income for accounting? So we always start with the net income because what we're saying is the accountants went in, they looked at all the income for accounting, they took off all the accounting expenses and came up with a net profit. Remember, net profit, not net income, net profit. We start with that figure. That figure has included all our accounting income, taken off all our accounting expenses. And what we now do is we start with that net profit and we say, well, if this increased our net profit and we know the tax position is different, then we decrease it. If it was an accounting expense that decreased our net profit, to reverse it, we increase our net profit, so we add it back, and then we deduct the correct amount. Now, a classic here would be borrowing expenses. The borrowing expenses would be an accounting expense, so they would reduce our profit. Let's say, for argument's sake, it was $1,000, so it would decrease it by $1,000. But we know that that's a capital expense for tax, so we add back the 1,000. So we're back to zero. We've negated the effect of that borrowing expense. So we come back to zero, and then we say, oh, we need to use 25/25, we need to work out the daily rate, multiply it by the number of days in the year that the loan was operating, and so maybe that comes to $50. So we will deduct for tax purposes $50. So we had reduced our accounting profit by $1,000, so to reverse it we add back the 1,000 and we decrease by 50. So every time you look at the figures, what you have to do is say, is this accounting income also income for tax purposes? If it's not, then we will reduce the accounting profit and add back the correct tax figure. If it's not a deduction for tax purposes, we add back the expense and we deduct the amount that's allowed under the Tax Act. You can then, of course, have amounts that are income for tax that aren't accounting income. And the classic one here is franking credits. Because when the accountants did the accounts, the cash dividend was included as income, but we know that for tax purposes we must also include the franking credits. So you would also include the franking credits. The sort of expenses that would be deductible, which aren't deductible for accounting purposes, would be borrowing expenses from an earlier year. That $1,000 borrowing expense, which we're looking at, what if it was paid last year? And last year the $50 was deducted. This year you'd be able to deduct, what did I say, it was $1,000, $200 this year. Now that won't have shown up in the accounting net profit, but it is a deduction for tax purposes. Similarly, Division 43 is a tax deduction, it's not an accounting deduction. So you will have those sort of things. Section 40-880 deductions. In the current year, let's say it was 10,000, you would add it, it would have dropped the profit by 10, so you add back the 10 and then you deduct 2,000. But that 2,000 is deductible for each of 5 years. So next year that would be a deduction. The following year it would be a deduction, and so on. Now, this is why you need to know all those sections really well, so that as soon as you look at an item of income or an expense, you say, well, that is the same in accounting as it is for tax, so we don't change anything. This is the same in accounting as it is for tax, so we don't change anything. This is different, so it's income, we need to get rid of it, so we minus it, we add back the correct amount. Then you look at all your deductions, and the same thing happens. Now, students find this very confusing, and it's your tax effect accounting that you've done earlier. But the difficulty is when you don't know those other sections, and so you're struggling to remember, oh, what do we do with borrowing expenses? What was that 40-880? Okay, so if you're struggling with reconciliations, go back and look at topics 1 and 2, and to a lesser extent topic 3. The real thing that's going to come out of there will be the general discount and your active asset discount. The other thing might be that the accounts may well show loss on sale of an asset, but if it's a capital loss and there's no capital gain, then you can't offset it, and so you would have to add it back, and then it would just stays there until there's an eventual capital gain in the future. So let's have a look here. We've got this suggested reconciliation process, and it's suggested and it's only a guide. We just couldn't put in every single thing. I've tried to put in as much as I can. So we start with accounting net profit. We add back income, which is income for tax purposes, so net capital gains, franking credits, non-cash business benefits. Then we also add accounting deductions, which are not tax deductions. So accounting depreciation, which is different to tax depreciation. Think about a low value pool. You've decided to use a low value pool for tax, but your accounting depreciation is calculated differently. Provisions. Remember that provisions are not incurred, so they're not deductions. So you would add back provisions and deduct the actual leave or the actual bad debt. Any capital expenses, so legal expenses, minor capital works, initial repairs. Excessive deductions for payments to directors or family members. Prepaid expenses for more than 12 months. And in fact, if it was prepaid towards the end of the year and the business wasn't SBE, then you would add back and just deduct the apportioned amount. You would then deduct things like tax depreciation, which is if it was SBE or an amount's under $1,000, you would deduct those. Building depreciation. And then you would take off any other tax deductions, like one 1/5 because, you know, it works out roughly, most loans are more than 5 years, so you're writing it off over 5 years. So the borrowing expenses, carry forward losses, Section 40-880, all those would come off, and that would equal your taxable income. Now, of course, if it was a partnership, it would equal net income. If it was a trust, it would equal net income. So now I have an example for you here. And what I've done with this is this little table, and there's a similar one in your book, is just to get you thinking about the effect on your net income or taxable income. So I'm saying add back, deduct, add back, deduct. And interestingly enough, there was a student in the last lot of exams who did the whole thing this way, but never came up with a profit figure. A taxable income or a net income figure. And this example is just to get you thinking, oh, it's a deduction, so I have to add it back and then I deduct the correct amount. This is income, so I have to deduct it and add back the right amount. So here we've got the sale of an asset that was held for more than 12 months. The profit is $50,000. The tax position is 25 because you get the 50% discount. So remember, because it was a profit on sale, it increased your profit. So we minus the 50 and we add the tax figure, which was the 25. So the income for tax was 25. So we took off the 50, added the 25. My students laugh at me in class because they sit there copying me and going, and if that makes it easier in your mind, you know, think about that. Well, it increased my profit, so I'm going to decrease my profit, and then I'm going to add back the right amount. If that asset above was an active asset, what's the difference? So again, it increased our profit by 50, so we decreased by 50. Because it's an active asset, we get the second discount, so we add back by 12.5. With a franked dividend of 14,000, 6,000 franking credits. Now here, not only do we include the 14, but we also need to include the 6,000 franking credits. Oh, a word of advice. When we're doing things like the capital gain or expenses or provisions, all those sort of things, always, so remember we had the 50, so decrease by 50, add back the 25. Or the 12.5. Lots of students say, I don't want to do that. That takes too long. And the reason I ask you to do the full amount, the full adjustment, and then the correct tax adjustment, is students who do the net figure invariably net the wrong way. So instead of there being a 50,000 deduction and 25 income, so instead of deducting 25, they add 25. So that's why, and what happens is in the exam, because you're really rushing to get things done, and you're under a bit of pressure and you're a bit nervous, you tend to net it the wrong way. So I always say to students, do the full amount and then just add or deduct the correct amount. With franking credits, you don't need to do that because this is an additional amount that's coming in. So you just add in the franking credits. So here you would just add the 6,000. Then we've got an STS asset. And let's say the accounting depreciation was 10%. So the accounting deduction was $90. So the profit dropped by 90. We're going to add back the 90. So we bring ourselves back to 0, and then we deduct the 900, which is the correct deduction for tax. And then we've got a provision for leave of 12,000. You cannot deduct a provision for tax, so we deduct the 12. We deducted the 12. We're going to add it back because no leave was actually taken. That's it. Okay. If I said that leave of $2,000 had been taken, then you would deduct the 2,000. So here we've got this example, the partnership of Horton and Oates. And we have here the accounting profit, and then you're given some extra information that they had acquired a factory building, and they've taken out a loan, and a staff member took long service leave, and the franking credits are 8571. Calculate the net income of the partnership. Now this is a good opportunity to stop this recording and try and do it yourself. So you start with your net profit of 94,500. You're going to look at each item of income and say, is that income also income for tax? Is that deduction also deduction for tax? If not, you reverse the effect it had on the net profit and include or take off the correct amount for tax purposes. So here we start with our net profit of 94,500. We add back the franking credits. Oh, sorry, we don't add back. We add in the franking credits because they're income for tax, but they weren't anywhere in the accounting profit. And we add back the provision for long service leave because it's not an incurred expense. We add back the borrowing expenses and we add back the initial repairs. So that takes us to 121,671. And then we deduct from it the correct borrowing expenses worked out on the basis of dollars and cents per day multiplied by the number of days. I cannot tell you how many exam papers I mark, and people refuse to do that, and they just divide by 5 or something like that, and they come up with the wrong figure. Then we deduct the actual long service leave taken, and we deduct the Division 43 deduction because that is not an accounting expense, but it is a deduction for tax purposes. So our net income is 93,780, which is very, very different to our accounting net profit of 94,50. So that is a reconciliation. We reconcile from our accounting profit to our taxable income or net income. We are reversing the effect that the income or the deduction had on the accounting profit, and then we are putting in the correct tax figure. We include as income things like non-cash benefits and franking credits, and we allow deductions for things like borrowing expenses, section 40-880, which may well have been incurred in earlier years but are written off over a period of time. And we have that difference between accounting depreciation and tax depreciation. So if you're not familiar with those things, if you can't remember how they happen, go back and review them again. And the best way to become familiar with reconciliations is to do them and do them and do them again. And remember, your best feedback is from doing the questions without looking at the answers. If you can do that, then the feedback you get is you've done enough work. So please go and do the reconciliation questions without looking at the answers. That'll give you a really good idea of whether you understand this concept or not. But talk it through with your friends. What is the concept? We're reconciling from accounting to tax. So we're removing accounting income that isn't tax income, or we're adding the correct amount.